During the end of World War II, the United States, had their currency pegged to gold, and other currencies agreed to peg themselves to the dollar. If a country produces more than it consumes, it has like a trade surplus, and so that usually makes its currency stronger and stronger, and that tends to make its exports less competitive and increase its import power.
It's often said that there have been previous reserve currencies, and that's mostly true. However, they're not really the reserve currency in the same way. So historically, it was really, gold that was kind of the real reserve currency. But there were some, currencies like the British pound that, were accepted very broadly. So they had kind of the previous mantle of, global reserve currencies. And especially, roughly after World War II, the United States dollar became the de facto world reserve currency. And that kind of took two forms. So the first form was the Bretton Woods system. And so, during and after World War II, the United States was kind of the big country left standing. So Europe was damaged by the war, Japan was damaged by the war, and the U.S. was relatively untouched. And it was also, the largest creditor nation. So the U.S. had owned more foreign assets than foreigners owned of their assets, because they were like lending for the war and they were doing all sorts of stuff. So the United States was in a superpower position almost uniquely. So there's a couple ways to monitor the health of the petrodollar system. And so one of the ways is basically to see if there's persistent global dollar shortages. And so this has been a topic that a lot of macro analysts have covered over the past decade. That we've been in a period of more frequent dollar shortages. And so if you look back historically, these dollar shortages happen during big spikes in the dollar, but they tend to be relieved more quickly. Whereas because we've had an increase in global debt, and because we've had a decrease in the United States' share of global GDP and global trade, that's put a lot of pressure on the circulation of dollars around the world, and the availability of dollars to service debts or to buy commodities as needed. And so the plan at the time was that the dollar backed its currency by gold, and then other currencies pegged themselves to the dollar. So we had a lot of fixed exchange rates, and it kind of made for a pretty smooth system for a while. However, that started to break down after a couple decades because so much gold was leaving the U.S. because the dollar was convertible to gold, and we were printing a lot of money, and also there were foreign markets could make dollars essentially. They could lend dollars. And so the amount of dollars in practice expanded because of the whole fractional reserve system. And so more and more foreign investors wanted the gold instead of the dollars, and they started to basically call our bluff. And so Nixon closed the gold window, and that ended the Bretton Woods system. Now, and then a couple years after, in the really early 1970s, they established what is essentially a petrodollar system, where the dollar in some ways backed by oil. And the way that works is that the United States made certain deals with certain countries so that they only price their oil in dollars. So even if a European buyer buys from, say, Saudi Arabia, they're paying in dollars, which is neither of their currencies. And so for almost 50 years now, the United States has had a pretty hard lock on virtually all oil pricing globally and many other commodities. And that's what kind of makes the global reserve currency, is the idea that nations around the world buy commodities, particularly oil, in dollars. Because of that, countries around the world hold treasuries in their foreign exchange reserves, so that they always make sure they have dollars on hand. During the end of World War II, the United States, had their currency pegged to gold, and other currencies agreed to peg themselves to the dollar. And that was because the United States was, they were the dominant force after the war. They had most of the gold. They had, the least harmed economy compared to many of their allies and enemies. And so they were in a position to basically be the axiom of the system. And there were some competing forces back then. So there were some people that were advocating for something like a bancor, which would have been essentially a basket of multiple currencies, like a neutral reserve asset. But then, of course, the United States' position was arguing in favor of making the dollar itself the center of the system. And so over time, the system's been fraying around the edges. And then, of course, you can separate different periods of time who's benefiting, who's being harmed by it. So the United States, earlier in the petrodollar system, was benefiting from it. It increased the United States' hegemonic power. But the sacrifice we had to make was, in order to supply the world with all these dollars to buy oil and all of this, we had to run persistent current account deficits. So we have a reformation of the Triffin dilemma, except instead of being focused on the capital account, it's focused on the current account. And so if you look at the United States' long-term trade deficit, current account deficit, it really collapsed starting in the mid-70s when we shifted away from the Bretton Woods system and towards the petrodollar system. After World War II, the United States was almost 40% of world GDP because, like I said, we were the most untouched by the war. And over time, as Europe and Japan recovered, and then as we've seen the rise of China and other emerging markets, the United States is an increasingly small percentage of global GDP. We're still a very large percentage, but it's now closer to 20%. And in purchasing power parity terms, it's actually less. It's in the high teens. And now China is the biggest commodity importer instead of the United States. So it's very hard to price all currencies in the dollar when the U.S. is not even the biggest importer of commodities anymore, and when we're an increasingly small share, still a large share, but a smaller share of world GDP. And we're starting to see, for example, Russia's looking to price its oil in euros. We've seen China and Russia between themselves drastically reduce their dollar-based trade in the past 2 years. And so we're starting to see kind of a fracturing of the long-term system, and we're starting to see a little bit more currency diversification happening. So we have to supply a crazy amount of dollars to the rest of the world, and that was started at first intentionally with the whole petrodollar system, but it becomes self-perpetuating because now there's so much dollar demand out there that it keeps our dollar price pretty strong. And so we have a lot of importing power and very weak exporting power. If a country produces more than it consumes, it has like a trade surplus. And so that usually makes its, currency stronger and stronger. And that tends to make its exports less competitive and increase its import power. So over time, that often kind of normalizes, unless they do kind of currency manipulation to try to weaken their currency. On the other end of the spectrum, if a country's importing more than they're exporting, they develop a trade deficit, and usually when a recession comes or some other kind of catalyst, usually they have a pretty significant currency devaluation, and it's painful, but then it makes their exports more competitive and it reduces their import power, and that helps them kind of normalize and start building up from there. The US never really gets that corrective cycle. So our currency is, we're pretty much always running big trade deficits, and in order to be the world reserve currency, you kind of have to do that because it's not, the whole world can't buy oil in dollars if there's not enough dollars out in the world. So historically, it was really, gold that was kind of the real reserve currency, and then other currencies pegged themselves to the dollar. So we had a lot of fixed exchange rates. They were in a position to basically be the axiom of the system, and that tends to make its exports less competitive and increase its import power.